Welcome to The Explainer. Look, as a professional trader, I've spent thousands, and I mean literally thousands of hours staring at charts, digesting economic reports, backtesting strategies, the whole shebang. But today, we're going to confront a really hard truth together. We're going to shatter the illusion that simply having better market analysis automatically equals better trading results, because it doesn't. So we're going to pull back the curtain on the actual, literal driver of consistent profits. We're talking about trading psychology.
Okay, let's dive into this, because this is the massive elephant in the room, isn't it? I mean, you know how to identify an uptrend, you know exactly what a head and shoulders pattern looks like, or how to spot bullish divergence. So why are you still losing money? Why is there such a frustrating, painful gap between your market knowledge, this unlimited potential to make money, and what actually ends up hitting your bottom line at the end of the month?
Well, to understand why we get so stuck, we kind of have to trace how Wall Street itself has evolved. Back in the late 1970s, fundamental analysis was basically the only game in town. The old guard thought technical analysis reading price action was just absolute mystical hocus pocus. Then, by the 1980s, the tide started to turn. The shift to technicals really took off, and today, practically everyone uses charts. But here's the thing. The truly cutting-edge traders out there are realizing we're in the middle of a third shift, mental analysis. You see, we've mastered the math, and we've mastered the price patterns, but we absolutely haven't mastered our own minds.
So let's talk about why that very first phase, pure fundamental analysis, ultimately failed so many independent traders. It created what we call a reality gap. See, mathematical models, they're perfectly logical. They weigh interest rates, balance sheets, supply and demand, and they tell us exactly what the price should be. The problem? The actual human beings trading the markets and moving the volume usually don't have the slightest concept of those models. They are acting on emotion. And when clean, clinical logic collides with messy human emotion, yeah, logic usually loses.
That reality gap is exactly why the whole industry shifted over to technical analysis. As traders, we collectively realize, hey, people repeat the exact same emotional behaviors over and over again. Technical analysis is brilliant because it takes all that chaotic, collective emotional behavior and organizes it into identifiable repeating patterns. It keeps you hyper-focused on what the market is doing right now, turning the market into this endless stream of opportunities. It's a fantastically powerful tool, which is exactly why you spent so much time and energy trying to master it.
But here is where we hit a massive brick wall. Just because you have the tools to spot an opportunity doesn't mean you have the right mind to execute it. The author makes this incredible comparison. The average trader is like the Earth, and the consistent winner is like the Moon. I love this. They exist in the same solar system, they look at the same markets, but they operate in fundamentally different psychological environments. Down here on Earth, the average trader sees the money flowing. It feels like it's right there in their grasp, but they live in a constant state of fear and emotional pain. Meanwhile, the consistent winner up on the Moon, they've broken through. They operate effortlessly.
Now, what's really interesting about this is that if consistent trading was just about being incredibly smart or working super hard, you'd expect society's absolute brightest minds to just dominate the markets, right? But they don't. In fact, the largest group of consistent losers is made up of doctors, lawyers, engineers, scientists, and CEOs. It turns out, being able to perform literal brain surgery or run a Fortune 500 company does not stop you from completely panic selling at the bottom of a trend. Raw intelligence and great analytical skills just aren't the defining factors here.
So, if it's not a sky-high IQ, and it's not some top-secret chart indicator you haven't discovered yet, what on earth is it? The winning edge is a totally unique mindset. Consistent winners simply think differently. They have developed a highly specific set of attitudes that allows them to stay disciplined, focused, and incredibly confident, even when the market is throwing absolute chaos at them. They've essentially rendered themselves immune to the everyday fears that completely paralyze the rest of the trading community. And those everyday fears, they are unbelievably costly. I want this number to just burn into your memory. 95%. Let that sink in. 95% of the trading errors you are likely making right now, the exact errors causing your hard-earned capital to literally evaporate before your eyes, they don't stem from a faulty trading system. They stem entirely from your own attitudes. They come from your own internal fears.
We can actually break this down. Those errors are driven by 4 primary trading fears. The fear of being wrong, the fear of losing money, the fear of missing out, good old FOMO, and the fear of leaving money on the table. When you operate out of fear, your focus naturally narrows. It's a survival instinct. You literally block out rational, objective market data. You either freeze like a deer in headlights or you panic and run. You could have the most perfect, beautiful, technical setup in the world in front of you, but if even one of these 4 fears is active in your mind, I guarantee you will sabotage the trade.
Which brings us to a really harsh truth we have to face. Look, every single one of us watching this probably thinks of ourselves as a risk taker. I mean, we're traders. But let me ask you, do you really accept the risks just because you physically click the buy or sell button? The logical side of your brain says, well, yeah, trading is risky. I am currently trading, therefore I am a risk taker. But there is a massive, gaping psychological chasm between just assuming you're taking a risk and truly embracing a non-guaranteed outcome.
So, the crucial point is understanding this difference. Taking a risk is just clicking a button, crossing your fingers, hoping you win, and feeling completely sick to your stomach when the market ticks against you. If you feel emotional discomfort, anxiety, or fear while you're in a trade, you haven't actually accepted the risk. Actually, scratch that. You're fighting the risk. Truly accepting the risk, the way those consistent winners on the moon do, means you can put on a trade and take a loss without the slightest bit of hesitation, internal conflict, or emotional pain. To get to that elite state of true risk acceptance, you have to fundamentally rewrite how you view the market. Listen to me. The market is entirely neutral. It's like a river. It doesn't know who you are. It doesn't care about your account balance or your mortgage or how bad your last trade was. It just moves, generating perfectly neutral information about itself. It quite literally does not possess the power to cause you emotional pain. Any pain you feel is strictly the result of your own faulty attitudes and perspectives distorting that neutral data. Let's walk through exactly how this plays out in real life. We call it the cascade of fear-based errors. You know the drill. First, because you haven't accepted the risk, the market starts moving against you. But instead of just cutting the loss like a robot, you start rationalizing. Oh, it'll bounce at this next support level. Then, because you took a bigger loss than you should have, you hesitate on your very next valid entry. Then, out of pure frustration from missing that move, you jump the gun and force a setup that isn't even there. And finally, you're just sitting there hoping and praying the market will magically save you. None of these errors come from the market. Every single one of them comes from you. And this brilliantly illustrates the biggest, most dangerous trap in the entire trading world. I call it the black hole of analysis. When traders experience the pain of those cascading errors, their immediate knee-jerk reaction is, I clearly need to learn more about the market to prevent this from ever happening again. So you dive into new indicators, new moving average crossovers, totally new methodologies. But here's the secret. You can never learn enough to eliminate the risk of the market proving you wrong. Trying to learn your way out of psychological pain is just a one-way ticket to ultimate frustration.
Because the hard, cold reality of this game is that absolutely every single trade has an uncertain outcome. Always. As long as you are trying to out-analyze the market just to avoid the pain of uncertainty, you are going to feel disappointed and betrayed. It's going to feel like you just can't trust the markets. But the painful truth? You simply can't trust yourself yet. True confidence doesn't come from a magic indicator. It comes from training your mind to override your natural human inclination to avoid pain, so you can finally act in your own best interest with zero hesitation.
Achieving this consistency requires an absolute paradigm shift. This quote hits the nail right on the head. The successful trader you desperately want to become doesn't just need a new charting package. You literally have to grow into a completely new version of yourself. Developing a real trader's mindset means being willing to abandon almost everything you currently believe about risk and the nature of trading. It's no longer about looking outward at the charts. It's about looking inward. So let me leave you with this ultimate question. You spent years analyzing the market, right? You know the patterns inside and out, you understand the math, but the missing link to the exact consistency you're chasing, it's standing right there in the mirror. Are you finally ready to step away from the screens for a minute, stop trying to predict the totally unpredictable, and start doing the heavy lifting of analyzing your own mind? Because that, my fellow traders, is the only true road to lasting success. Thanks so much for joining me on this explainer, and I'll see you on the next one.
Welcome to This Explainer. Grab a seat. Now, if you're tuning in today, you're probably either eyeing a jump into the financial markets, or, let's be real, the markets have already started chewing you up and spitting you out. Today, I'm stepping in as your mentor. We're going to look way past the charts, past all those fancy indicators, and dive straight into the unvarnished truth about the psychological wilderness of trading. Think of this as your mind's ultimate survival guide.
So, let's start right here. Why do highly successful people, we're talking doctors, engineers, brilliant CEOs, consistently fail at trading? It's kind of fascinating, right?
You'd naturally assume that having high intelligence, a top-tier education, or a track record of crushing it in business would translate directly to the trading floor. But wow, the reality is a brutal wake-up call for a lot of rookies. We see blown accounts and shattered egos all the time.
And the core paradox of this entire profession really comes down to this quote: "Unlimited possibilities coupled with unlimited freedom present unique psychological challenges." Look, we all assume freedom is just purely a good thing, but out there in the markets, that ultimate freedom is literally the exact thing that destroys people who just aren't mentally equipped to handle it. Okay, let's dive into part 1, the ultimate freedom trap. We really need to unpack why we're all so magnetically drawn to the markets in the first place, and why that exact attraction sets a massive hidden trap. If you ask any rookie why they trade, they'll usually tell you it's for the money, right? Or maybe the action, the adrenaline rush, or just the chance to be a hero. But beneath all that surface-level stuff, the fundamental true attraction is the unlimited freedom of creative expression. What everyone is truly chasing, whether they realize it or not, is an environment where they get to make absolutely all the rules. To put into perspective just how absolutely boundless this playground really is, think about this number for a second: 8 billion. If you combine bond futures, bond options, and the cash bond markets, you get over 8 billion possible spread combinations. 8 billion. Add in your own timing, constantly shifting market conditions, and the choices are virtually infinite. There are literally zero restrictions telling you what you can or cannot do.
So, let's move right along to Section 2, the baggage we bring. This is where the real danger starts creeping in. You see, absolutely no one comes into the market as a blank slate. Every single trader unknowingly drags this heavy, invisible mountain of psychological baggage from their childhood right up to the trading screen. Consider the stark contrast of how we grew up. From the very moment we're born, we're dropped into a social environment completely defined by rigid rules, restrictions, and boundaries that were set in stone way before we even got here. Society keeps us safe by putting limits on how we express ourselves. But the trading environment? It is the exact opposite. It's unrestricted, completely chaotic, and it absolutely demands that you make your own rules. And this massive clash creates what our source calls a mental vacuum. Spinoza, the philosopher, noted centuries ago that nature abhors a vacuum. Well, when an inner, natural impulse, think of like a toddler's pure, innocent curiosity to go grab a fragile vase, is denied expression by the outside world yelling no, it creates this huge emotional imbalance. Boom, a painful void is suddenly carved right into our mental framework. Now, I want you to multiply that single no over the first 18 years of your life. That's roughly 6,570 days. How many times did you hear, no, you can't do that, or you have to do it this way, or you have no choice? Even just hearing that a few times a day adds up to thousands and thousands of denied impulses by the time you're an adult. Basically, we unknowingly build up this massive, dangerous psychological backlog of resentment. So the absolutely crucial question here is what happens to all that unfulfilled energy? Well, nature's built-in biological mechanism for reconciling these denied impulses is simply to cry. But let's face it, society trains us out of crying pretty quickly, doesn't it? So this unreconciled emotional energy doesn't just poof and vanish. It accumulates, it stews, and eventually it mutates into compulsive behaviors and addictions later in life. We compulsively seek out whatever we feel we were deprived of, and wouldn't you know it, the market is the absolute perfect enabler.
Which brings us right to part 3, a boundaryless environment. I really need to warn you right now about how this specific childhood baggage becomes incredibly lethal when you step into the financial arena, because unlike normal society, the market offers you literally zero built-in safeguards.
Let's break down a quick blackjack analogy to see exactly why this is so dangerous. In a casino, the rules force you to define your risk up front, before a single card is dealt. There's a rigid start, a middle, and a highly formal end to every single hand. You are forced to be an active loser. But trading? Oh man, trading happily lets you risk everything you own without a second thought. There is no forced risk definition, prices are in constant motion, and there is absolutely no formal ending to a trade until you finally decide to pull the plug.
This total lack of structure creates a genuinely terrifying reality on the trading floor: the passive loser. In trading, the market is not going to politely tap you on the shoulder and take you out of a bad trade. Once you're sitting in a losing position, you don't even have to make another decision to keep losing. You can lose everything you own and then some, just by sitting there staring blankly at the screen and doing absolutely nothing. The market is always moving, and if you let it, it will take the whole shebang. Moving into Section 4, the 3 trading traps. When you mix this limitless, unstructured market freedom with that deep-seated emotional baggage we just covered, you are setting the stage for disaster. Let's look at the roadmap of your internal enemies. If you're going to survive out here as a pro, you need to recognize and dismantle 3 hidden mental traps: the unwillingness to create rules, the failure to take responsibility, and an addiction to random rewards. Let's see exactly how these try to sabotage you. Trap number 1 is that stubborn unwillingness to create rules. Remember that massive backlog of denied childhood impulses we talked about? Well, when we finally discover the market, this magical place offering complete, unrestricted freedom, we naturally and very intensely resist imposing any strict boundaries on ourselves. Actually, putting in a rigid trading plan or honoring a hard stop-loss feels exactly like yielding to those same authority figures who stifled us growing up. We finally found our utopia, and our minds will subtly but fiercely fight any attempt to build walls inside it. Then there's trap number 2, the failure to take responsibility. Look, we all desperately want freedom of choice, sure, but we aren't always so eager to accept the consequences when things inevitably go wrong. So, what's the easy, coward's way out? Engaging in random, unstructured trading. Because if you trade randomly, just on a whim, and you lose, hey, you can easily shift the blame. It's the broker's fault, the Fed's fault, or just a crazy algorithmic spike. It is way easier to blame an outside variable than to look in the mirror and take responsibility for your own undisciplined analysis. Now, to wrap our heads around the 3rd trap, the source material introduces a really fascinating psychological study. It's a famous monkey experiment designed to test how different reward schedules affect sustained behavior. And honestly, this gives us the biological proof for why our brains get so easily hijacked by the market's unpredictable payouts. Here's how it works. If you teach a monkey a task and reward it consistently every single time, it learns the pattern. But the moment you stop handing out that reward, the monkey quits immediately. It knows the game is over. But if you put that monkey on a random reward schedule, mind-blowing difference, it will expend energy indefinitely, continuously mashing that button or performing that task. Every unexpected win triggers a massive release of euphoria-inducing chemicals. Random rewards make chaotic behavior unbelievably addictive. And this perfectly illustrates the true, hidden danger of that addiction. It leaves you in a totally powerless state of what they call choicelessness. When you're addicted to the rush of a random win in the market, your autonomy is completely stripped away. You aren't executing a disciplined, calculated plan anymore. Nope, you are powerless, forced to satisfy the urge for that next random hit. At that point, you're literally just treating the global financial market like a giant slot machine.
So, moving into our final section, Part 5, Mastering Internal Control. How do you step out of that casino mindset and step into the professional arena? Well, surviving the market requires a complete paradigm shift. You absolutely have to abandon the control tactics that society spent years teaching you.
This right here is exactly why those highly successful CEOs fail so miserably at trading. In everyday society, success is built on your superior ability to manipulate the external environment to get what you want. You negotiate, you influence people, you control outcomes. But the market is a vast psychological wilderness. It does not know you, it does not care about you one bit, and it absolutely refuses to be manipulated by you.
So, the absolute most vital takeaway I can give you today is this. Instead of trying to control our surroundings, we can learn to control ourselves. Then, and only then, can we perceive information objectively. Think about it. Since you have zero control over the market's endless, chaotic stream of prices, your only real option is to rigidly engineer your own mental mechanics. You've got to step up and build the structure inside your own mind that the market refuses to provide for you. Which leaves us with this final, uncompromising ultimatum. Are you trading just to express your freedom, running around trying to satisfy all that childhood baggage we talked about? Or are you trading to consistently win? Because the hard truth is, you simply cannot do both. The market? It's perfectly happy to take your money either way. But if you truly want to survive and thrive out here as a professional, the choice of how you build your internal environment is entirely yours. Thanks for joining me on this explainer. I really hope this arms you for the mental wilderness ahead.
Welcome to This Explainer. Look, as a professional floor trader, I have been exactly where you might be sitting right now. I've stared at the screens for hours on end, felt that absolute, sickening gut punch of a blown account, and honestly, I've wondered why the market seemed to be personally attacking me. If you're totally exhausted by that emotional roller coaster and you are ready for a much-needed psychological intervention, well, you're in exactly the right place. Today, we are breaking down the ultimate professional trader's blueprint. I'm going to hit you with a hard truth right out of the gate. The consistency you seek is in your mind, not in the markets. Seriously, stop looking for the holy grail in just one more chart pattern or some shiny new algorithm. Endless chart reading absolutely will not save you if your mental environment is a total mess. So here's our agenda for today. First, we're going to unpack the novice trader's trap. Second, we'll face the harsh reality that the market owes you nothing. Third, we'll expose the knowledge illusion. Fourth, we're dissecting the boom and bust cycle. And finally, we'll talk about taking absolute responsibility. Let's dive in. Section 1. The novice trader's trap. Think back to your very first few trades. Chances are you had a completely carefree state of mind. And why is that? It's simply because you hadn't experienced the genuine pain of the market yet. You know, rookie luck is a very real phenomenon because the novice enters what athletes call the zone completely by accident. They aren't weighing the consequences or second-guessing themselves because they literally don't understand the inherent dangers involved yet. They're entirely free from that paralyzing fear of losing capital. But notice the stark contrast that develops later. When that rookie luck inevitably runs out and the novice takes a real hit, their mindset drastically shifts. Suddenly, they start operating out of fear, they blame the market, and literally everything becomes about just avoiding pain. Now, the professional trader, on the other hand, they've worked incredibly hard to return to that carefree state of mind. But they don't do it out of ignorance, they do it by completely 100% accepting risk. They expect positive overall results, but they accept that individual outcomes are just reflections of their current skill level. They've essentially eliminated fear-based errors. Section 2. The market owes you nothing. Zero. That is exactly the amount of concern the market has for your expectations, your hopes, your dreams, or the fact that you really need this specific trade to work out to pay your rent. It is a completely neutral, zero-sum game. And the reason that zero hurts us so deeply is that when the market goes against us, we naturally revert back to childhood psychology. Think about when you were a kid and an adult abruptly took away a toy you were playing with. You felt powerless, angry, and betrayed, right? The cause of your pain came from the outside. Well, as adult traders, when a trade abruptly shifts from green to red, we subconsciously associate it with that exact same childhood feeling. We feel betrayed by the market, as if it purposefully swooped in and took our joy away. So, I want you to do a quick self-audit right now. When your stop loss gets hit, what is your immediate emotional reaction? Do you immediately get angry at the market makers? Do you feel cheated? Or do you take a breath, look inward, and take absolute responsibility for your own execution? All right, Section 3, the knowledge illusion. It is absolutely crucial to understand this devastating sequence. First, you experience the emotional shock and pain from a loss. Second, to protect your ego, you blame the market. Third, and hey, this seems like a completely logical, responsible step, you dive into obsessively learning technical analysis. You're suddenly an expert on trend lines, Fibonacci retracements, oscillators, you name it. But here's the massive trap in step 4. You secretly start to expect the market to obey your newfound knowledge. You trick yourself into thinking that if you just know enough, the market won't be able to hurt you anymore. But by doing that, you just created an irreconcilable dilemma. Going on a knowledge quest, not to extract money, but simply to avoid the pain of being wrong, that literally seals your fate as a consistent loser. Why? Because the more you learn just to avoid pain, the more you expect the market to do your bidding. And when it inevitably doesn't, the pain is compounded big time. You'll start hesitating, second-guessing absolutely perfect setups, and missing massive opportunities because you're no longer trading to win. You're trading not to lose. Section 4. The boom and bust cycle. Be really honest with yourself for a second. Where do you sit in this distribution? Less than 10% of active traders are consistent winners. About 30 to 40% are consistent losers. But I want to focus heavily on the largest group right in the middle, the 40 to 50% who are boom and busters. If you're in this group, you've actually figured out how to make money. You go in these amazing winning streaks, but you haven't yet learned the mental skills required to actually keep the money you make. The culprit for the bust part of that cycle is almost always euphoria. It is the silent account killer. It's this wild sense of supreme confidence where the possibility of anything going wrong is virtually inconceivable to you. A string of winning trades feels absolutely amazing, but if you haven't developed intense internal restraint, euphoria completely takes over. You literally stop perceiving risk. And the result? A vicious roller coaster equity curve. Driven by that euphoria, you completely abandon your risk management. You put on a position size that is way, way too large because, hey, you can't lose, right? But the market rarely agrees with our euphoria. When it predictably moves against that heavily overleveraged position, you just freeze. The financial impact is massive, and that feeling of emotional betrayal sends you crashing right back down to earth. It's a massive boom followed by a completely devastating bust. Which brings us to our final section, Section 5, taking absolute responsibility. So here is your real blueprint for rebuilding your mental environment. First, stop fighting the market flow. You cannot flow with something you are actively treating as an enemy. Second, you have to acknowledge that every single outcome is self-generated. Third, understand that the market doesn't create your state of mind, it simply acts as a mirror, reflecting what's already inside you back out. And finally, you must actively develop rigorous restraint to counteract that euphoria when you do start winning consistently. The consistently successful trader that you desperately want to become, they don't exist yet. You actually have to create a brand new version of yourself. Just as a sculptor works with clay or marble, your medium is your own mental environment. Your willingness and your burning desire to learn are your tools. You have to consciously sculpt out the fear, the anger, and that desperate need to be right, and meticulously install the beliefs of consistency and absolute discipline. I want you to burn this quote into your memory. If you resolve from this point forward to do it all yourself, the market can no longer be your opponent. The exact moment you stop projecting your hopes onto the charts and step fully into the role of a completely responsible professional, the entire game changes for you. I'll leave you with this final provocative thought. Look back at your trading history. If you could somehow magically redo every single losing trade that was the direct result of a mental error, a total lack of discipline, or just sheer recklessness, how much money would you have? What would your equity curve look like right now? I guarantee you it would look vastly different. That realization right there is exactly why taking absolute responsibility is the only true path forward, because your success and your failure has always been entirely up to you. Hey everyone, welcome to This Explainer. Pull up a chair, get comfortable, and let's treat this like a private mentorship session. You know, I've spent years analyzing the markets, and today we are looking at the absolute turning point in a trader's career. We're talking about making that massive leap from someone who occasionally catches a lucky good trade to a truly consistent professional. Our source material today lays out a really foundational truth. Just because you are acting in the capacity of a trader, clicking buy or sell, does not mean you've learned the appropriate way to think about what you do. The best traders out there aren't separated by what they do or when they do it. They are separated entirely by how they think. So if trading is so easy, why is it so incredibly difficult to master? Man, it's literally the most agonizing question in this profession. Experiencing just a few winning trades can convince almost anybody that trading is just incredibly easy. I mean, recall your own experiences. Those times when money just flowed into your account and you suddenly thought you were the next Warren Buffett. It feels totally effortless. So if we've all experienced how easy it absolutely can be, why are so many traders at their wits' end grappling with this obvious contradiction? Why can't we just make what we've learned work for us over and over again? Okay, let's dive into this. Here is the irony that trips up most amateurs. Trading can absolutely be as fun and effortless as your best experiences, but experiencing that consistently is entirely a function of your perspective and your mindset. If you depend on the outside conditions of the market to make you happy, meaning, you only feel good when the market hands you a win, it is extremely unlikely you will ever experience happiness or profits on a consistent basis. Professional traders, on the other hand, well, they are consistent as a natural expression of who they are internally. Their consistency doesn't rely at all on what the market happens to be doing today. Our source establishes this absolute core premise. Consistency is a state of mind. The solutions are in your mind. They are not out there in the market. Winning and consistency are states of mind in the exact same way that happiness, having fun, and satisfaction are states of mind. You can try to force consistency without having the appropriate internal beliefs, but your results won't be any different than if you tried to force yourself to be happy when you're actually miserable. It simply doesn't work. Your state of mind is always a byproduct of your beliefs. Now, this brings us to a really fascinating abstract distinction. You cannot try to be consistent. I know that sounds wild, but the best traders don't try to be consistent, they simply are consistent. Think back to your very best trades. You didn't have to force them, right? There was no struggle. You saw exactly what you needed to see, you acted, and you were just completely in the moment. When you're in the flow like that, you aren't trying, because everything you know about the market is just completely available to you. Now, what's really interesting about this slide is how it breaks down the dangers of trying to force results. The fascinating and honestly often frustrating truth is how the very act of trying acts as this huge psychological roadblock. When you try to get what you want from the market, it indicates that there is a degree of internal resistance or struggle. You are literally attempting to impose your will on the market. This perspective is just fraught with difficulties because it immediately takes you out of the opportunity flow. The market is just offering information. It's you who's creating the struggle. And here is exactly what happens when you impose your expectations on the market and the market doesn't comply. Your mental defense mechanisms kick right in. Our minds are biologically wired to avoid both physical and emotional pain. So when the market doesn't behave the way that fulfills your expectations, your brain automatically blocks or obscures that threatening information. You will literally pick and choose market data that confirms what you want to happen. And trust me, I've caught myself doing it early in my own career, just to shield myself from the emotional discomfort of being wrong. 95%. This is a hard truth, but an absolutely essential one for your development. The threat of pain generates fear, and fear is the source of 95% of the errors you are likely to make. Just let that massive number sink in for a second. You literally cannot be consistent if you are constantly making errors driven by the fear that what you expect won't happen. In this state, everything you attempt will seem like you're struggling against the market. But actually, scratch that, the market isn't against you. The struggle is entirely inside your own mind. So the crucial point is, how do we stop this cycle? Well, the answer is incredibly profound. You have to learn to truly accept the risk. Now, most traders assume that simply putting on a trade means they've accepted the risk. That couldn't be further from the truth. Accepting the risk means accepting the consequences of your trades without emotional discomfort or fear. If you are afraid of the consequences, your perception of the market's information is going to be filtered right through that fear, basically guaranteeing you create the exact experience you are trying so hard to avoid. When you adopt the thinking strategy of a professional, you create a completely new relationship with the market that disassociates trading from the traditional pain of being wrong or losing. If the possibility of losing or leaving money on the table doesn't cause your mental defense mechanisms to kick in, then the market literally has no power to take you out of the opportunity flow. You won't be trying to get anything from the market, and you won't be trying to avoid anything either. You will just be available to take full advantage of whatever conditions you define as opportunities. But here is the ultimate challenge for anyone watching this explainer. How do you accept the risks of trading without emotional discomfort, when at the very moment you perceive the risk, you simultaneously feel that discomfort and fear, right? How do you remain confident when you are absolutely certain you could lose money? After all, your fear feels completely justified and completely rational the moment you decide to interact with the market. To answer this, our source text provides just a brilliant analogy. Imagine a man who is deathly afraid of snakes. He's at a dinner party with his 3-year-old daughter, and the host's child brings out a pet snake. The father practically leaps across the room, knocking over chairs in pure absolute terror. But his little daughter? She is completely enthralled, probably trying to pet the thing. The father was shocked. He assumed his fear was a universal reality. But without having been taught to be afraid or having a prior painful experience, his daughter's natural reaction was pure, unadulterated fascination. And this brilliantly illustrates the biggest myth about professional traders. Most traders assume the best traders are also afraid of losing, but somehow neutralize their fear with an inordinate amount of courage, self-control, and nerves of steel. But that just isn't true. Needing courage implies an internal conflict where one force is counteracting another. If you truly accept the risk, you don't perceive the market as threatening. If there's nothing threatening, there's nothing to fear. If you aren't afraid, you literally don't need courage or nerves of steel. The snake, just like the market, isn't inherently terrifying. It just is. So how do we get there? Think of your mental environment like software code. You could have thousands of lines of perfectly written code, but if just one character is out of place, it can completely ruin the performance of the entire system. Finding that one misplaced character takes real expertise, but once you fix it, everything runs smoothly. For most traders watching this, you might only be one mental click or degree away in perspective from the ideal mindset, but that one misplaced assumption about the nature of trading is holding back your entire system. Let's move to and see how this builds. So, how do we actually debug our mental system? People usually describe shifting these internal assumptions as an aha experience. You know, the moment the light bulb goes on, the world suddenly seems totally different. You might say, man, why didn't I see this before? It was right in front of me. This happens when we locate a contradictory belief, acknowledge it, and finally align our mental environment with the reality of the market. But be warned, mere awareness is just not enough. Being aware of a concept doesn't automatically make it a functional part of your identity. You can't just assume that agreeing with a trading principle means you believe it at a level where you can actually act on it. Going back to our snake analogy, the terrified father could learn that the pet snake is completely harmless. He could rationally acknowledge it, but could he touch it? Probably not. The awareness that the snake is safe and his deep-seated fear of snakes exist side by side as a massive contradiction. In trading, I hear it literally all the time. People pounding the table, claiming, I am a risk taker, while simultaneously trading in a way that actively avoids all risk. That is holding conflicting beliefs. It's exactly like driving with one foot slammed on the accelerator and the other on the brake. Holding on to these contradictory beliefs turns learning how to trade into pure exasperation. Our source text points to the classic 1960s movie Cool Hand Luke. Luke is in a chain gang, constantly defying the prison bosses. They force him to do agonizing work and give him intermittent beatings, constantly asking, have you got your mind right yet, Luke? Eventually, after immense suffering, he tells them he has his mind right. Many traders are honestly just like Luke. They try to have it their way by beating the market, and as a result, they get financially and emotionally pulverized. Make no mistake, the market will relentlessly test your conflicting beliefs. You will endure the financial equivalence of those beatings until you finally realize that the market is just a mirror reflecting your internal software. There are easier, infinitely more satisfying ways of getting what you want for the market, but you simply cannot bypass the psychological work. So as we wrap up this explainer, I leave you with this absolutely crucial question to reflect on before your next trade. Are you finally ready to stop fighting the market, resolve your internal contradictions, and do the work to get your mind right? Welcome to this explainer. Look, speaking to you as a professional trader, I'm just going to give it to you straight and share a hard truth that completely changed my entire career. The market isn't causing your pain. Your own mind is. Today, we're going to fundamentally shift your perspective. We're going to look under the hood at the invisible forces driving your trading decisions, and I'll show you exactly how to debug your mental software so you can finally execute with absolute clarity. Here's our roadmap to taking you from a reactive amateur to an objective professional. We'll hit 1. The professional trader's mindset. 2. Debugging your mental software. 3. The closed loop of perception. 4. The boy and the dog. 5. The power of association. And finally, 6. Trading without fear. Let's jump right in. Section 1. The professional trader's mindset. Let's start by diving into a truly profound realization. The source material states it perfectly. Professionals don't perceive anything about the markets as painful. I mean, really think about what that actually means for a second. If there's no perceived threat, well, there's absolutely nothing to defend against. As a result, there's simply no reason for your conscious or subconscious defense mechanisms to kick in. You're completely free to just act on what the market is showing you without all that internal friction. We've all been on the amateur side of this equation, right? Beginners are literally paralyzed by fear because every single tick against their position feels like a direct personal attack. They're terrified of getting stopped out, so their mental defense systems are just working in overdrive. But compare that to the pro. The professional trader operates in the flow state. Why? Because they perceive market information totally neutrally. They just see an endless stream of opportunities without any of that distortion or hesitation. It's a real game changer. Moving on to Section 2, debugging your mental software. So, our primary objective here is redefining your relationship with market information. If you want to train like the pros, you absolutely must change your perspective. We need to alter that mental framework that taps you into emotional pain when you're just staring at the DOM or managing an open position, and instead install one that keeps you laser focused on the opportunities right in front of you. But to pull that off, we first have to understand the nature of mental energy. The absolutely crucial point here is understanding this concept of structured energy. Because, our memories and beliefs, they don't take up physical space like atoms, right? The source explains that they actually exist as a form of energy. Every past trade, every euphoric win, every agonizing drawdown, it all literally exists inside your mental environment as structured energy. And here's why this is absolutely crucial to you as a trader. That internal energy acts as an active force. It completely filters and shapes exactly how you perceive the outside world, and yes, that includes your trading screens. Which brings us to Section 3, the closed loop of perception. Let's see how this builds over time. Think back, way back, to the very first time you ever looked at a price chart or a level 2 screen. Step 1, you probably just saw a bunch of confusing, squiggly lines that meant absolutely nothing. It was just noise. But eventually, in Step 2, you learned to make distinctions. You learned about trends, support, resistance, volume, which leads directly to Step 3, where those previously confusing lines now represent an endless stream of actionable opportunities to fulfill your goals. Now, the fascinating core takeaway here is about those chart patterns. The price chart itself never actually changed. Everything you can read on that chart today existed back when you were a total beginner. It was all right there, available to be perceived. But because you didn't have the structured energy, the knowledge and distinctions inside of you yet, those opportunities were literally invisible to you. Your internal mental energy completely dictates what you are capable of seeing in the external market. Crazy, right? All right, Section 4. The boy and the dog. To really grasp this, imagine a young child encountering a dog for the very first time. At point 1, his mental environment is a clean slate. No memories of dogs at all, so he approaches with just pure curiosity and excitement. But at point 2, disaster strikes. The dog happens to be mean and it bites him. This traumatic experience creates a massive amount of painful, negatively charged mental energy. Now look at point 3. Months later, he encounters a completely different, totally friendly dog that just wants to play. What happens? He experiences unprovoked, absolute terror. This perfectly captures the devastating reality of his new mental software. The moment he comes into contact with any other dog, he is going to experience fear. It doesn't make a bit of difference if this new dog is the friendliest golden retriever on the planet. The child's fear is 100% real to him, even though it has absolutely nothing to do with the actual playful nature of the second dog. He is completely trapped in a perceptual closed loop. Let's tie this back to the markets in Section 5, the power of association. Notice how these scenarios mirror each other so perfectly? Our minds are just hardwired to involuntarily associate things that feel similar. Just like the traumatized boy sees a friendly dog and his mind instantly links it to his past attack, you see a perfectly valid entry signal and involuntarily link it to your last string of red days. The boy perceives the dog as dangerous, you perceive the market is out to get you. The result is the exact same: paralyzing hesitation and missed opportunity. What you're experiencing at your trading desk is exactly what psychologists call a projection. Your mind instantaneously and totally unconsciously associates the now moment with past pain. The boy projected his internally generated pain onto the playful dog, firmly convinced the dog was the threat. As a trader, you reflect your negatively charged energy from past losses onto current, totally neutral market data. You're basically convincing yourself the market itself is the source of the danger. Finally, Section 6, trading without fear. Notice how the exact same market signal produces completely different, totally irrational reactions based entirely on your recent past. In Scenario 1, you just took 3 losses. The market generates a valid signal, but your mind associates it with recent pain. It feels overly risky, so you hesitate and agonize while the trade just takes off without you. But in Scenario 2, you just had 3 huge winners. The market gives you the exact same signal. This time, your mind associates it with winning. The trade feels completely riskless, leading to euphoria, and you end up sizing way up and throwing risk management right out of the window. Both of these reactions are completely detached from objective reality. The professional trader breaks this vicious cycle by internalizing a few core truths. The market does not generate inherently positive or negative information. Upticks, downticks, they're neutral. Each trade is simply an edge with a probable outcome. And most importantly, every single moment in the market is statistically independent of every other moment. Your last trade has absolutely zero bearing on your next one. To succeed consistently, you have to take conscious control of your mind's natural propensity to associate the present moment with past baggage. I'll leave you with this final, provocative thought to take to your very next session at the desk. The next time you feel your stomach drop or you hesitate on a perfectly valid entry signal, I want you to pause and ask yourself, Is the market actually threatening me right now, or am I just looking at my own internal fear reflecting back at me? Master that distinction, and you will finally be trading in the zone. Thanks for joining me on this explainer, and I'll see you next time.
Listen to me carefully. You don't have a technical analysis problem. You have an expectation problem. If your trading consistency is completely dictated by your last 2 or 3 trades, you're running on flawed mental code. Period. Welcome to this explainer. I spent years in the trenches analyzing the markets, and today, well, we are going to completely shatter the illusions you probably have about trading. We're stepping away from the charts and indicators for a minute to look at things from the market's own perspective. So let's just dive right into it.
There's more to being consistent than the ability to pick an occasional winner. Most people who get into trading think that being a trader is exactly the same thing as being a great market analyst. But man, that couldn't be further from the truth. Think about it. If your perception of risk right now is totally emotionally hijacked just because your last trade was a loser, or maybe you're feeling a little invincible because your last 2 trades hit big, your mental software is literally corrupted. You aren't trading the reality in front of you. You're reacting to ghosts of the past.
Which brings us to Section 1, Flawed Mental Code, Psychological Variables. See, the typical trader's mind is a total prisoner to recent outcomes. If they just got burned, they suddenly see risk everywhere, even in an absolutely perfect setup. But the best traders in the world, they've got this massive psychological gap. They are virtually unimpacted by their last few trades. It's like water off a duck's back for them. They operate entirely in what we call the now moment opportunity flow. They aren't trying to avenge a previous loss or fiercely protect a recent win. They're just reading the present moment. So why is this so incredibly difficult for the rest of us? Well, the biology behind our struggle is actually fascinating. To trade effectively in what we call the zone, you need to be completely in sync with the market. But we have a division of labor in our brains. Our rational left brain, it specializes in what we already know. It craves certainty. It desperately wants to prove that our analysis is right. But the market itself is entirely creative. It's constantly bringing forth something that literally didn't exist a second ago. To tap into that flow, to actually trust an intuition or a hunch, you need your creative right brain. But here's the catch. There is an inherent conflict here. Unless you specifically train your mind, your rational, logical left brain is almost always going to override your right brain. It'll talk you right out of the best trades simply because it can't mathematically prove the outcome beforehand. Moving on to Section 1, Illusion of Certainty, Overcoming the Left Brain.
To break that illusion, you absolutely must adopt the uncertainty principle. Guys, this is the secret right here. At the core of your ability to trade without fear, to accurately perceive what the market is offering, and to stay in that now moment so you can spontaneously enter the zone, you need one crucial thing. And that is a virtually unshakable belief in an uncertain outcome. You have to believe, without a single shred of internal conflict, that your edge places the odds in your favor. But, and this is a big but, you absolutely do not know the outcome of this specific trade. You're just making yourself available to whatever the market offers.
So it all boils down to this incredibly simple 3-word phrase. Anything can happen. This isn't just some casual observation, okay? This absolutely must become your fundamental belief system. If you truly, deeply believe that anything can happen at any given time, there is literally nothing left for your mind to avoid, block, or rationalize away. You just stop fighting the market.
Okay, Section 3, Reality of Market Forces, Beneath Complex Charts.
It is shockingly simple when you really break it down. I mean, we spend thousands of hours staring at algorithms, moving averages, and Fibonacci retracements, right? But beneath all of that noise, there are really only 3 primary forces in any market in the world. First, traders who believe the price is low and are bidding it up. Second, traders who believe the price is high and are offering it lower. And third, a massive group just sitting on the sidelines waiting to make up their minds. That's the whole shebang. All price movement is just a function of what individual human beings believe about what is high and what is low.
And this brings us to a terrifying, yet kind of liberating truth. You can have the most sophisticated technical analysis on the planet. Your variables can align absolutely perfectly. But it only takes one other trader sitting anywhere in the world to completely negate your position. Just one single person with enough capital and a different belief about the future can blow your perfect chart pattern to pieces. No way around it.
Which leads us nicely into Section 4, the 10-cent lesson, arrogance versus reality.
Let me tell you a story. Years ago, there was this brilliant, but honestly, pretty arrogant technical analyst. He had lost all his money because he totally lacked mental flexibility. He eventually swallowed his pride and took a job as an analyst for a brokerage firm in Chicago. Now, the semi-retired chairman of this firm was a hardcore veteran trader with 40 years of experience in the grain pits. The chairman asked the analyst to sit down and teach him technical trading, and the analyst was just thrilled to show off. He used a method called point and line to accurately define support and resistance. So one day, the soybean market is trending down, and the analyst confidently points to his meticulously calculated support level on the screen. As the price slowly ticked down to that exact support level, the chairman looked at the analyst and asked, "So this is where the market is supposed to stop and go higher, right?" The analyst puffed up his chest and replied, "Absolutely. This is the low of the day." The veteran chairman just looked at him deadpan and said, "That's bullshit. Watch this."
Without hesitating for a single second, the chairman picked up the phone, dialed one of the clerks handling orders for the soybean pit, and very calmly said, "Sell 2 million beans at the market." Boom! Within 30 seconds of placing that order, the soybean market dropped 10 cents a bushel. It smashed right through the analyst's supposedly absolute perfect line of support. The chairman turned to the completely horrified analyst and calmly asked, "Now, where did you say the market was going to stop?" If I can do that, anyone can. Guys, the lesson here is profound. Your charts are just probabilities. Hidden variables, like a retired chairman with a point to prove and super deep pockets, are always operating in every market. Always. You literally can't account for everything.
So how do we fix this? Let's look at Section 2, Rules of Uncertainty, Fixing Mental Code.
To actually fix that flawed code, we first have to recognize what I call the trap of knowing. Have you ever wondered why typical traders commit financial and emotional suicide by refusing to use stop losses or taking profits when they obviously should? Well, the answer is simple and honestly really dangerous. The typical trader doesn't predefine his risk because he truly believes it isn't necessary. And why does he believe that? Because his ego tricks him into thinking he already knows what's going to happen next. Think about it. If you know for sure the market is going up, why on earth would you ever cut your loss? Believing you know what happens next is the root cause of virtually every single trading error. Therefore, the best traders operate entirely differently. Because they fully embrace the fact that anything can happen, they rely on an unbreakable regimen. Rule number 1, they consistently predefine their risks before even thinking about entering a trade. Rule number 2, they cut their losses without a shred of reservation or hesitation the moment the market tells them the trade isn't working. And rule number 3, they have an organized, systematic money management regimen for taking profits when the market actually goes in their direction. They don't try to intellectualize or rationalize away the unknown variables, they factor them directly into this exact regimen.
By strictly adhering to those rules, you train your mind for the most essential yet arguably the most difficult principle in trading, thinking strictly in probabilities. When you fully accept that the outcome of any single trade is completely independent from your last trade and totally uncertain, you literally free yourself. You simply execute your edge over a series of trades knowing full well that the math is going to play out in your favor over time, regardless of what one individual specific trade does.
And that brings us to the ultimate question, the one you need to ask yourself the very next time you sit down at your screens. Really look inward here. Are you trading the market's reality, fully accepting that it's an infinite stream of unknown variables where anything can happen? Or are you just trading your own rigid expectations, desperately hoping the market proves you right? Fix your mental code, embrace the uncertainty, and make yourself truly available to the opportunity flow. Thank you for joining me for this explainer. Keep at it, and until next time, stay focused out there.
Casinos pocket billions of dollars operating on purely random events, yet retail traders go broke chasing an illusion of certainty. If a single red trade triggers intense execution anxiety, your brain is running on flawed psychological code. Welcome to this explainer. Today, we are going to fix that code. Look, as a professional trader, I can tell you firsthand that the market, it doesn't care about your feelings. It doesn't care about your mortgage or how desperately you just want to be right. We're diving deep into the psychology of consistent success, and we're going to break down the exact mindset shift that separates the casino from the gambler. Let's get to work.
I want you to really absorb that brutal reality check because it diagnoses exactly why so many of you are struggling right now. The typical trader basically just wants to be right on every single trade. You know the drill. You sit down at your screens, you draw your trend lines, and you completely convince yourself you know exactly what the market is going to do next. But the moment the price ticks against you, your heart rate spikes, you start moving your stop loss, or you just freeze entirely. That intense execution anxiety is the ultimate proof that you're trading to prove you're right, rather than actually trading a mathematical system. You're chasing certainty in an environment that literally only offers probabilities.
So to understand how to fix this, we need to look at the ultimate model for profiting from randomness, and that is the gambling industry. The casino profit paradox boils down to a tiny number, just 4.5%. That's the edge a casino typically has over a player in a game like blackjack, based simply on the rules the players have to follow. Now, 4.5% doesn't exactly sound like a massive, insurmountable advantage, does it? The outcome of every single hand of blackjack is completely random and statistically independent from the last one. And yet, day after day, year after year, the casino makes consistent, highly predictable profits.
Let's ground this math for a second to see how that tiny edge translates into a massive empire. Suppose, over the course of a year, players collectively wager, say, $100 million at a casino's blackjack tables. With that 4.5% edge, the casino is going to net a highly predictable $4.5 million in pure profit. They don't need a crystal ball. They don't need to know if the guy in the blue shirt is going to hit or stand on a 16. That average naturally takes into account all the players who walked away big winners, the ones who lost their shirts, and literally everyone in between. Over a large enough sample size, the edge simply guarantees the outcome.
So what exactly is an edge in trading then? Well, it's nothing more than an indication of a higher probability of one thing happening over another. That's it. It's not a guarantee. It is definitely not a prophecy. The analytical tools we use, your moving averages, oscillators, retracements, they just define patterns of collective human behavior that happen to repeat over time. When you finally strip away the illusion that your charts are somehow telling you the future, you realize they're really just putting the odds of success in your favor. It's exactly the same way the rules of blackjack put the odds in favor of the house.
All right, let's move on to Section 1, Micro-Chaos, Macro-Certainty.
Thinking in probabilities requires you to hold two completely contradictory beliefs in your head at the exact same time. It's a mental split, and it takes some real effort to master, but once you do, it completely neutralizes the emotional threat of the market. At the micro level, you must absolutely believe in the uncertainty and unpredictability of every single individual trade. You have to accept that there are unknown variables, like some other trader somewhere in the world placing a massive order, that can instantly turn your perfect setup into a loser. But simultaneously, at the macro level, you have to believe that over a series of trades, the outcome is relatively certain and predictable. You essentially embrace the chaos of the single trade while relying entirely on the certainty of the sample size.
Because casinos don't have to know what's going to happen next, they don't place any special significance, emotional or otherwise, on any individual hand, spin of the wheel, or roll of the dice. Their egos just aren't involved. They don't have a burning, desperate need to be right about the next card. And as a result, they stay completely relaxed. The best, most consistently profitable traders out there use exactly the same thinking strategy. They execute flawlessly because they know a single loss means absolutely nothing to their macro certainty.
Which leads me to ask you a very direct question. Why do you think unsuccessful traders are so obsessed with market analysis? Really think about it. If you intellectually know that the market is random and that any single trade can fail regardless of how incredibly good the setup looks, why do you spend hours staring at 1-minute charts? Why tweak your indicators like they're magic spells looking for that perfect entry? The truth is, most typical traders crave the sense of certainty that analysis appears to give them. They analyze endlessly, not to actually execute an edge, but to convince themselves they're right before they even put the trade on.
And here is exactly why they do it: the pain avoidance mechanism. Our minds are literally hardwired to protect us from both physical and emotional pain. Being wrong hurts. Losing money hurts a lot. So when a trader desperately wants to be right on every single trade just to avoid that pain, their subconscious goes to work to create certainty where it simply doesn't exist. This mechanism will literally cause your brain to block, distort, or completely diminish the significance of any market data that conflicts with your expectations. You'll ignore a glaring trend reversal, plain as day on the chart, just to avoid the pain of admitting your current position is wrong.
To show you how deeply ingrained this flaw can be, let me share a fascinating anecdote from the source material about a trader named Bob. So Bob was a highly experienced certified trading advisor. He'd been in the business for 30 years and managed about $50 million in investments. Bob was absolutely brilliant at market analysis, but he was stuck. Despite his incredible analytical abilities suggesting he should be seeing returns of around 150 to 200%, he could only ever produce a 12 to 18% annual return. He intellectually understood probabilities perfectly, but he didn't actually function from a probabilistic perspective. His fear of being wrong literally blocked his execution. Bob's journal entry on his belly trade captures this problem perfectly. He put on a trade in pork bellies and entered a stop loss. The market moved toward a stop, then bounced back to his entry point, where he immediately bailed out entirely out of fear. Almost instantly after that, the market surged 500 points in his original direction, but he was already out. Why? Because putting in a stop loss is not the same thing as actually accepting the risk. Bob didn't genuinely believe the market would trade against him. When it did, he got out with this vindictive "I'll show you" attitude to punish the market. He hadn't accepted the possibilities, so he couldn't execute his edge.
Let's move into Section 2, the 5 fundamental truths. To fix this whole issue, we need a complete psychological software update. You have to create a mental framework that is totally consistent with the underlying principles of a probabilistic environment. If you want to eliminate the threat of pain, these 5 truths have to become the foundation of your trading belief system. Let's walk through them. Truth number 1. Anything can happen. Literally anything. 2. You do not need to know what is going to happen next in order to make money. 3. There is a random distribution between wins and losses for any given set of variables that define an edge. 4. An edge is nothing more than an indication of a higher probability of one thing happening over another. And 5. Every moment in the market is completely unique. When you fully adopt these 5 truths, your expectations will finally align with the reality of the market, neutralizing that emotional risk entirely.
Which takes us to Section 3, eliminating the emotional risk. When you accept that every trade is a unique event with a totally uncertain outcome, and at the same time you believe in the predictability of your edge over time, trading actually becomes effortless. You enter a carefree state of mind. You stop trying to predict outcomes. You stop avoiding trades just because you're afraid of losing, and you stop jumping the gun. You just let the probabilities play themselves out. You have to understand that anything you are perceiving now in the market will never be exactly the same as some previous experience. Your mind naturally wants to associate the current setup with the last time you saw a similar pattern, especially if that last time resulted in a painful loss. But the traders making up the market right now, they're different people. Their motives are different. You absolutely must stop bringing the emotional baggage of past trades into the now moment. And that brings us to the ultimate behavioral difference between the amateur and the pro. In a probabilistic environment, you must be rigid and flexible at the exact same time. A professional trader is incredibly rigid in their rules. They never risk more than their predefined amount, they always honor their stop loss, but they are completely flexible in their expectations of what the market is actually going to do. The typical unsuccessful trader does the exact opposite. They are incredibly rigid in their expectation, they know the market is going up, so they become super flexible with their rules, bending and breaking their risk management just to accommodate that stubborn belief.
As we wrap up this explainer, I want to leave you with one final, absolutely vital question. Look at your recent trading history, think about your emotional state when you are in a position, and ask yourself honestly, are you trading to prove you are right, or are you executing an edge? If you feel stress, anger, or betrayal when a trade goes against you, you are still fighting the math. Embrace the uncertainty, respect the sample size, and let the probabilities do the heavy lifting for you. That is how you finally find your edge. Thanks for joining us for this explainer today, and stay focused out there.
Welcome to This Explainer. Look, I've spent years staring at charts, analyzing markets, and experiencing the exact same brutal frustrations that you probably have. As a professional trader, I can tell you right now that the hardest part of trading, it actually isn't reading the tape. It's not calculating risk either. It's managing the person staring back at you in the monitor.
In fact, I want you to listen closely to this statement. Most retail traders fail because their brains are hardwired to mistake a repeating chart pattern for a guaranteed outcome. If you struggle with hesitation, second-guessing, or execution fear, your problem isn't your technical analysis. Your subconscious mind is actively playing tricks on you. I have absolutely been there. You freeze up right before pulling the trigger, or you exit a perfectly good winning trade way too early out of pure panic. I want to validate that struggle for you right now because it is not because you aren't smart enough. It's just biology.
So that leads us to the ultimate question for this explainer. Why does your brain actually sabotage your trades? What is literally going on in your mental environment when you look at a live market? Well, to figure that out, we have to take a hard look at the very tools we use to trade. Okay, let's dive right into Section 1, the trap of chart patterns, because this is where the biggest mental paradox in the market begins.
We all use technical analysis, right? And technical analysis defines patterns. Because we see a pattern repeating, our brain automatically implies consistency. It implies a guaranteed, consistent outcome. But the reality is that each and every pattern is a completely unique occurrence. Think about it. Even if a chart looks exactly, pixel for pixel, the same as it did last week, the underlying force moving that price is people. It's traders. And the specific traders buying and selling today are totally different from the ones who built that pattern last week. So the outcome is actually fundamentally random relative to the past.
So you might be wondering, if outcomes are random, what is technical analysis actually doing for us? Well, it's just giving you an edge. And an edge is nothing more than an indication of a higher probability of one thing happening over another. That's the whole shebang. It's not a crystal ball. It is definitely not a guaranteed sequence of events. When you can shift your mindset from deterministic, meaning you think you know exactly what will happen, to probabilistic, the game completely changes for you.
The problem, though, is that our human brains absolutely hate probabilities. We aren't wired for them. We're wired for survival. And that brings us to Section 2, the brain's association mechanism.
Let me walk you through a classic analogy here to show you how this works. Imagine a young boy who gets bitten by a dog. The pain is intense, the shock is real. Automatically, without him even thinking about it, his brain links that terrifying experience to the general concept of dogs. Fast forward to the next day. A completely harmless, super friendly puppy waddles up to him. What happens? His heart races, he freezes, and he feels absolute paralyzing terror. His brain just projected a negatively charged past memory onto a completely neutral now moment. Now, what's really fascinating here is how perfectly this psychological trap maps directly to your trading. Seriously, think about it. The boy is you. That dog that bit you, that's that terrible trade you took last Thursday where you lost a huge chunk of your account. And the harmless puppy is just the current market opportunity. The market is just a stream of neutral up and down ticks, guys. It has absolutely no intention of hurting you. But your brain's association mechanism links the current chart right back to your past pain, triggering fear, hesitation, and a totally defensive state of mind. This association makes you believe you somehow know what to expect. And let me tell you, believing you know what to expect is a really dangerous trap. The instant you think you know exactly what the market is going to do next, you immediately stop taking all the unknown forces into consideration. You completely ignore the thousands of other traders around the world who could jump in and act as a force on price at any second. So, to stop your mind from making these painful, completely unhelpful associations, we need a totally new framework. Let's look at Section 3, the 5 fundamental truths. We need to establish some new core trading beliefs. All right, here are the 5 fundamental truths. 1. Anything can happen. 2. You don't need to know the future to make money. 3. There is a random distribution between wins and losses for any given edge. 4. An edge is literally just a higher probability of one thing happening. And 5. Every single moment in the market is mathematically unique. If you want to succeed, you absolutely have to integrate these truths into your mental system as core, unshakable beliefs. Let's actually isolate the hardest one for most people to swallow. You don't need to know what is going to happen next in order to make money. Mind-bending, right? So the crucial point here is that trading is simply a probability game. It's just a numbers game. When you truly deeply believe that, concepts like being right or being wrong completely lose their emotional power over you. Think of flipping a coin. If you flip a coin and it comes up tails 10 times in a row, what are the odds the next flip is heads? It is still exactly 50-50. If you have a valid trading edge, gathering outside evidence to somehow prove your next trade will work makes about as much sense as doing a rain dance to predict a coin flip. Adding random variables just destroys your consistency. And this brilliantly illustrates the reality of accepting random distribution. When you accept this, you finally accept the random distribution of your wins and losses. If your edge has a historical win rate, you know the wins are going to come eventually, but you don't know the sequence. That means a losing trade isn't a personal failure. A losing trade literally just puts you mathematically closer to your next winning trade. Honestly, you should be looking forward to the next occurrence of your edge without the slightest bit of hesitation. But to actually get to that point, you must deeply, fundamentally believe the fifth truth. Every single moment in the market is mathematically and fundamentally unique. No two moments will ever perfectly duplicate themselves. Believing in this uniqueness is the ultimate shield against your brain's association mechanism. Because if this exact moment has never existed before, well, you can't possibly associate it with the pain of the past. Which perfectly sets us up for Section 4, Mastering the Now Moment. Let's see how all of this builds into our ultimate objective, getting you into the proper state of mind to flawlessly execute your strategy. The goal here is a completely carefree state of mind. You want to be confident, but not euphoric. When you're operating in this state, you won't feel any fear or weird compulsions because you've effectively eliminated the potential to interpret market information as a threat. And how do you do that? By completely accepting the risk up front. When you truly accept the risk of a trade, you are at total peace with whatever the outcome happens to be.
And when you accept that risk and you finally stop trying to protect yourself from the market, your mind just opens up to a true exchange of energy. You stop predicting, you just let the market tell you from its own perspective what is likely to happen next. This, my friends, is what it actually means to spontaneously enter the zone.
So, we arrive at the ultimate dividing line. What is the exact thing that separates the absolute best, most consistently profitable professionals from the amateur traders who just keep blowing up account after account?
Here it is. The best traders have trained their minds to believe in the absolute uniqueness of each moment. They completely disassociate the now moment in the market from any previous moment filed away in their brain. They come to the screens every day with absolutely no agenda other than to just let it unfold, making themselves fully available to the flow of opportunity.
Look, the market is going to do what it's going to do. The patterns will appear, the probabilities will play out, and the unique moments will just keep flowing by, one after another. The only variable you actually have any control over is your own psychology. So I'm going to leave you with this. Will you keep fighting your own brain, gathering useless evidence to try and predict the unpredictable, or will you finally accept the risk, embrace the unknown, and step into the zone?
Welcome to this explainer. Look, I'm coming to you today not just as your host, but as a professional trader. And honestly, we're about to have a bit of a tough love intervention. If you're tuning into this, you're probably putting in the hours, right? You're studying the charts, you're backtesting all your strategies, and yet you're still really struggling in the markets. So why is that? Well, today we're going to completely unpack the exact hidden mechanism that's actually holding you back.
Listen to this carefully. Your current trading results are a direct reflection of your subconscious beliefs, not your technical analysis. If you consistently struggle with entry hesitation or cutting winners short, your brain is actively filtering out profitable chart data to protect your old mental programming. I want to completely shatter the illusion right here, right now, that you just need to find a better trading strategy or, tweak your indicators one more time. The problem absolutely isn't your system. The problem is your internal filter.
Section 1. The subconscious trading filter. Okay, let's dive into this, because there's a massive, often invisible conflict between knowing your technical analysis and actually functioning objectively in the live market. You see, most of us make this huge mistake of assuming that once we logically understand something, that insight just magically becomes a functional part of who we are. But actually, understanding a concept is really only the very first step. I mean, you can spend thousands of dollars on technical systems trying to figure out what's going to happen next. But what if you've recently learned that to be successful, you actually have to think in probabilities? That means accepting you don't need to know what happens next. Boom, you now have a direct conflict. Your new logical understanding is completely battling an old, deeply ingrained, sabotaging belief that absolutely demands certainty. And guess which one usually wins when real money is on the line? The old belief, every single time.
Section 2. How beliefs are formed. To fix this core problem, we have to kind of deconstruct the mind a bit. We need to look at the origins of a belief and understand what it is we're actually fighting against when we sit down at the trading desk.
Let's move to and see how this builds. Picture a newborn baby. At the very beginning, memories exist just purely as sensory information, what the infant sees, hears, smells, or feels. This is pure memory. Then, as the child grows up a bit, they're taught a symbol system, language. When a child links that pure sensory memory to words, they form a concept, like connecting a warm feeling of being nurtured with the words, "life is wonderful." Finally, when positive or negative emotional energy gets attached to that concept, it transforms into a belief. It literally goes from a meaningless abstract phrase to a highly energized absolute truth about reality.
So a belief isn't just some passing thought. A belief is essentially structured energy. It's a rigid concept about how the world works, structured by language and heavily energized by our life experiences. These beliefs actively dictate your reality.
And what's truly kind of terrifying is that a lot of the beliefs causing you the absolute most difficulty in your trading right now, they were acquired from other people, totally without your conscious consent, when you were just way too young to realize the negative implications of what you were absorbing.
Section 3. 4 functions of beliefs. Once a belief is born into existence, it functions in a very specific, mechanical, undeniable way. Just like your eyes are literally designed to see, or your teeth are designed to chew, your beliefs have designated jobs they absolutely must perform.
So, I want to pose this direct question to you. What exactly does a belief do? Think about it. If I asked you what your nose does, you'd answer me in a second. But since beliefs are the most critical component impacting the quality of our lives, and especially our trading accounts, it's a massive irony that they're almost always the least thought about and least understood part of our anatomy.
So here are the 4 distinct functions of every single belief you hold in your head. 1. They manage your perception and interpretation of environmental information. 2. They create your expectations, which, if you think about it, are really just beliefs projected into the future. 3. They dictate your outward behavior and the physical decisions you make. And 4. They shape exactly how you feel about the results of your actions. Seriously, every piece of data you see on a trading chart and every single time you click buy or sell, those actions are being entirely dictated by these 4 sequential steps.
Section 4. The free money experiment. And this brilliantly illustrates exactly how these functions operate in the real world. Let's look at a famous practical joke from a 1987 TV show called Gotcha Chicago.
So the TV station gave a man a literal briefcase full of cash and instructed him to just stand on the sidewalk along Michigan Avenue. Now, for context, this is a very busy, very wealthy area of the city, lined with exclusive boutiques. He just stood there holding a simple sign that read, "Free money, today only." His instructions were simple. Give money to anyone who simply asks for it.
Imagine the sheer absurdity of this scene. A man with pockets stuffed full of cash, desperately trying to give it away on a crowded street full of people who basically dedicate the vast majority of their waking lives to the pursuit of money. And what happened? Out of all the people who walked by and read the sign, almost everyone completely ignored him. The guy eventually grew incredibly frustrated, literally crying out, "Please take my money, I can't give it away fast enough." Still, people actively altered their paths, walking completely out of their way just to avoid him. It's wild.
So why did the average pedestrian just ignore him? The environment was offering an experience anyone would love, free cash, no strings attached. But the average person holds a deeply energized belief that free money just doesn't exist. So their brain instantly reconciled that contradiction by deciding, well, the man must be crazy or dangerous, which results in the behavior of avoiding him. Conversely, the only person who did stop was a panhandler who asked for a quarter for a bus transfer. The panhandler operates under the belief that free money actually does exist. The exact same environmental data, the man and the sign, was filtered completely differently based on their conflicting internal beliefs.
So the crucial point is the emotional outcome. The pedestrian felt a sense of relief for successfully dodging a potentially dangerous, crazy person. The panhandler felt a sense of satisfaction for getting his quarter. Both of their emotional states completely, 100%, validated their respective beliefs. Yet, from the perspective of what the environment was actually offering, the pedestrians completely missed the reality of the situation. Their beliefs literally blinded them to the opportunities sitting right in front of their faces. Does that sound at all familiar to your trading?
Section 5. Beliefs versus the truth. This brings us to our final philosophical reframing. What actually is the truth, and how exactly does this translate to fixing your broken trading results?
I really want to challenge you with this question. If our beliefs naturally impose limitations on our awareness, literally forcing us to only perceive information that is consistent with what we already believe, then how do we ever know what the actual truth is? The market environment can express itself in an infinite combination of ways. Therefore, our beliefs are merely limited statements about reality, not definitive ones.
Now, what's really interesting about this slide is the crucial distinction between absolute truth and useful truth. Look, if our beliefs were an absolute truth, like a 100% accurate reflection of physical reality, then our expectations would always be fulfilled and we'd just be in a perpetual state of satisfaction. But obviously we aren't. So instead, we have to measure our beliefs by a useful truth. The relative degree of truth inherent in our beliefs can really only be measured by how effectively they actually help us accomplish our goals at any given moment.
And here is where that professional tough love comes right back into play. Take a hard look at your trading.
If you find yourself in a state of dissatisfaction, disappointment, frustration, confusion, or despair relative to the market, it means one incredibly simple thing. The beliefs you are operating from do not work. They're not useful. The market environment is just pure data. It's offering absolutely zero resistance. The only resistance, the only counteracting force that's diminishing your outcome, is your own mind fighting against the reality of the market.
Let me leave you with this final provocative thought to wrap up our explainer today. The truth is a function of whatever works in relation to what we are trying to accomplish at any given moment. If your core goal is to be a consistently profitable trader and your current mindset just generates hesitation, fear, and loss, then your current trading truths are useless. So I have to ask you, which of your deeply held beliefs about the market are you finally willing to discard so you can actually start seeing the opportunities right in front of you?
Your subconscious mind is actively capping your trading profits without your permission. If you keep hitting an invisible glass ceiling where you consistently give back all your gains, this explainer breaks down exactly why. It's literally one of the most frustrating, mysterious, and honestly universal challenges in the entire trading world. Today, we're cutting right to the core of market psychology to figure out what's actually happening behind your screens. Seriously, does this sound familiar? You string together a brilliant series of winning trades. Your equity curve is climbing beautifully. You're feeling unstoppable. And then, out of nowhere, bam, you experience a massive drawdown. You make totally uncharacteristic errors. And, we usually just blame it on the vagaries of the market or a sudden run of bad luck. But is it really just luck? Or is there something operating right beneath the surface, effectively pulling the emergency brake on your success? Let's get right into Section 1, the invisible glass ceiling, and look at these invisible barriers. This is where we really start to map out the tip of that psychological iceberg almost every single trader eventually crashes into. Okay, let's dive into this. The source material identifies the actual real-world manifestations of self-sabotage that completely ruin our equity curves. We're talking about those random lapses in focus. Suddenly putting in a buy order when you clearly meant to sell. Or maybe you just let yourself give in to distracting thoughts. You walk away from your monitors for like 5 minutes and you come back to find out you completely missed the absolute biggest trade of the day. The text points out that these aren't just random accidents. These errors consistently happen when you hit a very specific subconscious threshold in acquiring equity. You hit that invisible barrier and your own mind finds a way to force the money right out of your account. Moving on to Section 2, Anatomy of a Belief and the Mechanics of the Mind. If we want to stop this self-sabotage, we've got to pop the hood and understand what's actually happening in our mental environment. The source presents this really fascinating, almost physical theory about how our minds work. It proposes that our beliefs aren't just fleeting thoughts floating around, they're actually structured energy. And not just that, it's energy that acts like it's conscious. They act as a literal force on how we perceive market information and how we behave. So we're talking about a real energy dynamic operating right inside your head. And because these beliefs are made of energy, they follow 3 specific rules. Number 1, they resist alteration. Just like a law of physics, energy can't be destroyed, so you cannot just hit delete on a belief. Number 2, all active beliefs demand expression. When they get triggered, that energy just floods your system. And number 3, they keep working unconsciously, completely regardless of whether you're actively thinking about them or not. To really ground this abstract concept, let's head into Section 3, The Boy and the Dog, which explores childhood conditioning. The source uses an absolutely brilliant analogy here to explain how this conditioning creates these permanent energy structures. Imagine a young kid who has a terribly painful first encounter with a dog. His mind's natural pain avoidance mechanism immediately kicks in. He forms this highly energized, absolute belief, all dogs are dangerous. Because of that word all, this belief acts as a completely paralyzing force. It demands expression by making him feel pure terror every single time he even sees a dog, thereby ensuring he avoids pain in the future. But then, the boy goes through what's called a creative experience. This happens when you experience something completely outside the boundaries of your current beliefs. So say the boy is walking with his parents, comes around a blind corner, and unexpectedly sees a bunch of kids his own age just playing joyfully with some dogs. Nobody's getting hurt. He's suddenly confronted with indisputable information from his environment that completely contradicts his absolute belief. This beautifully illustrates his ultimate internal conflict. On the one hand, he has a conscious desire. He sees these kids having fun and, well, he wants to play too. But on the other hand is his unconscious belief that highly charged energy screaming, all dogs are dangerous. The absolute crucial point here is this. What happens next is entirely determined by which side has more energy. And because that childhood fear is so deeply rooted, the intensely charged negative belief is going to completely paralyze him. He literally cannot step forward. It completely overrides his conscious desire to play. So, what's the solution? It's not forcing it. The answer is deactivation. Remember, he cannot just destroy the fear. You can't destroy energy. But by taking tiny, incremental positive steps, like maybe just standing a little closer to a dog without getting hurt, he can gently draw the energy out of that negative belief. Eventually, he transfers that energy into a new, functional belief. Like, okay, most dogs are friendly, but some can be mean. He essentially melts that barrier away. All right, section 4, subconscious self-sabotage and the subconscious limit. Let's see how this all ties directly back to your trading and that invisible glass ceiling we were talking about earlier. Think about your self-valuation. It's like a scale. It's the balance of positively charged beliefs arguing for your success weighed against negatively charged beliefs arguing against it. So where do those negative beliefs even come from? Well, just like the kid bitten by the dog, we pick them up incredibly easily in childhood. Maybe you accidentally hurt yourself while misbehaving and a parent said, "See, God punished you." You subconsciously associate guilt with being unworthy of success. Or maybe you were just taught that rich people are inherently greedy. These beliefs get buried so deep, but their negative energy remains fully active. When you trade with a positive sense of self-valuation, you are in the zone. Equity just seems to magically flow into your account because your conscious goals and your subconscious beliefs are in perfect alignment. But if you have unresolved guilt or deep-seated beliefs that you're undeserving, you enter the negative zone. Just like the boy's paralyzing fear of dogs, your subconscious literally treats a red candle like a rabid wolf, forcing you to make trading errors. It forces you to interpret normal market information as threatening, which causes stress, anxiety, and ultimate self-sabotage, right up until your bankroll drops back down to the exact level you subconsciously believe you deserve. That brings us to Section 5, deactivating limiting beliefs and taking control. It is time to melt away this barrier once and for all. The source material is very clear here. We don't have to go through years of deep psychoanalysis to dig up every single childhood trauma. Instead, exactly like the boy slowly stepping through his fear of the dog, a trader just needs to become highly aware of these self-sabotaging beliefs the precise moment they demand expression during a session. You have to actively train your mind to expect unique outcomes from the market, rather than letting old, fearful energy dictate how you perceive a trade. This is the climax of the whole concept, right here. You must take an active role in training your mind to believe in the uniqueness of each moment, and you must deactivate any other belief that argues for something different. This is absolutely key. It doesn't just happen by osmosis. This active, deliberate mental training is the ultimate secret to achieving consistent success as a trader. You are consciously building an entirely new belief system. The main takeaway here is pretty profound. The market environment itself is practically limitless. It offers endless opportunities to accumulate wealth. It is not the market that's capping your profits. It's your own internal energy dynamics. Your own sense of self-valuation is literally the only thing deciding how much of that wealth you actually allow yourself to keep. So I'll leave you with this final thought. Are you going to take the active steps to deactivate the conflicting forces in your mind, or are you going to let your subconscious keep giving back all your hard-earned gains? The choice and the mental work is entirely up to you. Thank you so much for hanging out with me on this explainer. I really hope this completely changes how you view your next trading session. Keep learning, keep growing, and I'll catch you next time.
Stop trying to predict the future to win your trades. The absolute secret to professional execution is learning to operate in a state of not having to know what happens next. Listen to me carefully here, because what we're going to cover in this explainer is going to completely rewire how you interact with the markets as a professional trader. If you are just exhausted by the emotional roller coaster of trading, the hesitation, the premature bailing out, the devastating losses, you are absolutely in the right place. We're going to unpack the exact psychological framework that separates consistent professional market players from, everyone else.
Honestly, operating in that state of not having to know what happens next, it is the ultimate superpower. You do not need a crystal ball to be a highly profitable trader. In fact, relying on your own intellect to somehow outsmart the market is the exact illusion that's holding you back. When you convince yourself that you know the next tick on the chart, you are attaching your ego to the outcome. And that desperate need to know, that need to be right, it guarantees that you'll misread the data and totally sabotage your own execution.
Okay, let's dive into this.
Section 1. The Prediction Trap.
It sounds totally counterintuitive, right? I mean, in almost every other profession on Earth, the more you know, the better you perform. But trading is fundamentally different. It is simply a pattern recognition numbers game. The more you think you know what the market is going to do, the less successful you'll actually be. The moment you assume you know what happens next, you automatically expect to be right. And when the market inevitably does something different, your brain interprets that information as painful. It triggers these conscious and subconscious defense mechanisms that literally blind you to the real opportunities right in front of you. Amateurs live in this illusion. Because they have to know what happens next, they are terrified of being wrong, and they go to incredible lengths to avoid acknowledging a mistake. But the pros, the professional mindset, thinks strictly in probabilities. They execute their edge purely mechanically. They completely accept risk, which means they can look at market data objectively, without any of that emotional pain.
To really grasp what happens when you refuse to acknowledge a mistake, imagine you're walking across a bridge that spans the Grand Canyon. The width of that bridge? That represents your position size. If you trade a single contract, you're strolling on a nice, comfortable 20-foot wide bridge. You've got a massive tolerance for error. But as you size up, that bridge shrinks. One massive floor trader, mentioned in our source material, used to regularly trade 500 to 1,000 treasury bond futures at a time. At that massive scale, the bridge narrows down to the size of a thin wire. One tiny misstep, one momentary gust of wind, or, in trading terms, one distracting thought where you lose focus and refuse to acknowledge an error, means you miss your split-second chance to liquidate. The result? A 1-mile drop straight down. Complete disaster.
Section 2. The Mechanical Stage. So take a breath. How do we cross this canyon safely? How do we stop those euphoric, reckless mistakes and that fear-based paralysis that ruins a perfectly good equity curve? Well, we do it by entering the mechanical stage. This stage is specifically designed to systematically strip away any susceptibility you have to making fear-based or euphoric errors. Look, this isn't about slapping a new indicator on your chart. It's about building internal self-trust, absolute confidence, and the real ability to think purely in probabilities. Once you master this stage, you build a steadily rising equity curve with only minor drawdowns. You virtually compel yourself to create consistent results.
Section 3. Rewiring your beliefs. Now, what's really interesting about this concept is that these trading skills we're talking about, they are entirely psychological in nature. In their absolute purest form, they are simply beliefs. And beliefs are just conscious, energized concepts that demand to be expressed in our lives. So if your main objective is to produce consistent results, you have to actively construct a dominant belief that says, I am a consistently successful trader. Now, you might think building that requires some innate self-discipline, but self-discipline isn't a personality trait you're just born with. It's a mental technique. The author of our source material shares this brilliant story from back in 1978. He was completely out of shape and decided, I want to become a runner. He set a goal to run 5 miles, but immediately his brain threw up massive conflicting thoughts. Oh, it's raining. I'm too tired. My favorite TV show is on. To beat this, he didn't use magic. He used self-discipline to simply redirect his attention. He made a strict rule. Put the running shoes on and just take one step further than yesterday. Little by little, those conflicting thoughts faded. The energy transferred. Eventually, he didn't even need the discipline anymore because I'm a runner had become his actual identity. We have to do the exact same thing with our trading.
Section 4. Principles of Consistent Success. To build that dominant belief that you are a consistent winner, you can't just wish for it. That's way too abstract. You have to break it down into 7 core sub-beliefs, which we call the principles of consistent success. Let's walk through them together. Number 1, I objectively identify my edges. Number 2, I predefine the risk of every single trade. Number 3, I completely accept risk or I am willing to just let go of the trade. Number 4, I act on my edges without reservation or hesitation. Number 5, I pay myself as the market makes money available to me. Number 6, I continually monitor my susceptibility for making errors. And finally, number 7, I understand the absolute necessity of these principles and therefore I never violate them. When you integrate these 7 principles into who you fundamentally are, trading consistently becomes effortless. I mean, it wouldn't even occur to you to trade without a stop loss, just like it wouldn't occur to a marathon runner to go out without lacing up their shoes.
So the crucial point is Section 5, trading like a casino.
The real shift happens when we move your perspective from the gambler sitting at the slot machine crossing their fingers for a payout to the perspective of the casino owner. The casino owner knows exactly how the math plays out at the end of the day. The goal is to convince yourself, deep down, that trading is just a simple game of probabilities. At the micro level, the outcome of any individual trade is completely independent and entirely random. You literally cannot know if the next trade is a winner or a loser. But at the macro level, over a whole series of trades, the outcomes will always produce consistent results as long as the odds are in your favor. When you trade like the casino, you own the game.
But to actually prove this to your own mind, you have to stop living and dying on the result of your most recent trade. You have to commit to trading in sample sizes. For any edge you define, you need a systematic approach over a sample size of at least 20 trades. Why 20? Because 20 trades gives you enough data to filter out the random variables. It lets you truly evaluate if your edge works without emotionally breaking down just because you caught 2 or 3 losses in a row.
Section 6. The risk-free opportunity.
Okay, to permanently integrate these principles into your mental environment, our source gives us an exact, rigid trading exercise. This is where the mechanical stage hits the actual markets. And listen, this exercise demands absolute precision. First, you pick a market and you choose an edge. Your trade entry variables must be 100% objective. If the market aligns, you take the trade, period. Zero subjective judgments. Second, your stop-loss exit has to be strictly defined by market structure, not some arbitrary dollar amount you pulled out of thin air, and you determine it before you ever click buy or sell. Third, your entry and exit signals must all be based in a single time frame to avoid any conflicting data. No extraneous factors allowed. This is purely mechanical execution.
And this brilliantly illustrates what is widely considered the absolute hardest skill to master in trading, taking profits. Seriously, think about it. If you genuinely accept that you never actually know how far the market is going to go in your direction, how on earth do you know when to take your money off the table?
The most effective psychological solution here is to scale out of your position. Divide your position into thirds. When the market moves just slightly in your favor, take 1/3 off immediately. In the source text, the author noted that when trading T-bond futures, the market almost always went his way by a few ticks before pulling back or reversing, so he built a habit of taking profits right there. Once you take that first third off, you immediately move your stop loss on the remaining position to your original entry point. Then you just let that final portion run to a larger, predetermined, longer time frame objective. What you've just created with this setup is profound. You have manufactured a risk-free opportunity. Because you booked that initial profit and moved your stop to break even, there is literally no way for you to lose money on this trade under normal market conditions. The psychological relief of this is just staggering. The panic vanishes. You actually get to experience what it genuinely feels like to be in a winning trade with a completely relaxed, carefree state of mind. You have finally detached your ego from the outcome.
Look, as long as you are trying to guess the next move just to prove how smart you are, the market will find your emotional weak spots, and it will absolutely exploit them. But the very moment you accept the randomness of the micro and trust the consistency of the macro, the whole game changes. So, are you finally ready to let go of your ego? Are you ready to drop that desperate need to know the future and start executing your next 20 trades just like the casino? Start the exercise. Change your beliefs. It's time to take your edge back.